The Indian stock market, vibrant and dynamic, is no stranger to global influences. Among the most significant of these are foreign institutional investors, often referred to as FIIs. These are entities based outside India that invest in Indian securities, including stocks, bonds, and other financial assets. Think of them as large institutional investors with a global outlook, seeking opportunities in emerging markets like India. Why are they important, you ask? FIIs bring much-needed capital to India. This is particularly crucial for a developing economy like ours, where domestic savings often fall short of funding ambitious growth aspirations. They are like bridges, connecting India to the global pool of capital. Their importance, however, extends far beyond just capital infusion. FIIs play a crucial role in deepening our financial markets, improving corporate governance standards, and enhancing the overall efficiency of the Indian economy. In essence, FIIs are not just investors, they are important stakeholders in India's growth story. FIIs encompass a wide range of entities, each with its own investment strategy and risk appetite. These include pension funds, mutual funds, hedge funds, insurance companies, and even sovereign wealth funds. Each of these entities manages vast sums of money, and their investment decisions can significantly impact market movements. But how do they operate in India? FIIs need to register with the Securities and Exchange Board of India, or SEBI, the capital markets regulator. This registration process ensures they adhere to Indian regulations and safeguards the interests of the domestic market. Once registered, FIIs can invest in Indian securities through designated channels. They typically operate through dedicated funds or accounts, managed by professional fund managers. These managers conduct thorough research and analysis of Indian companies and market trends before making investment decisions. The process, though seemingly complex, is designed to ensure transparency and accountability, safeguarding the integrity of the Indian financial system. The impact of FIIs on the Indian stock market is undeniable. Their investment decisions can influence market sentiment, drive stock prices, and impact the value of the Indian rupee. When FIIs invest heavily in India, it signals confidence in the economy, attracting other investors and boosting market sentiment. This influx of capital can lead to a surge in demand for Indian stocks, driving up prices and contributing to a bull market. Conversely, large-scale FII outflows can spark a bearish trend, leading to a decline in stock prices and market pessimism. This sensitivity to FII activity underscores their significant influence on market dynamics. Beyond the stock market, FIIs also influence other aspects of the Indian economy. Their investments in debt securities impact bond yields and influence borrowing costs for the government and corporations. Moreover, their investment decisions can influence the value of the Indian rupee against other currencies. Section 4. The upside benefits of FID participation in India. The presence of FIIs in the Indian market brings a plethora of benefits. They are instrumental in enhancing market liquidity, improving corporate governance, and attracting global attention to the Indian economy. Their participation broadens the investor base, making it easier for companies to raise capital and for investors to buy and sell shares without causing drastic price swings. This enhanced liquidity is crucial for a well-functioning market. Furthermore, FIIs, being sophisticated investors, demand high standards of corporate governance from the companies they invest in. This pressure encourages Indian companies to adopt better transparency, accountability, and ethical practices, ultimately benefiting all stakeholders. Section 5. Navigating the tide challenges and risks of FII dependence. While FIIs bring numerous advantages, it's essential to acknowledge the challenges and risks associated with heavy reliance on foreign capital. One significant concern is the volatility they can introduce into the market. As we've seen, FIIs react swiftly to global events and changes in risk perception. This can lead to sudden and sharp movements in the Indian market, creating uncertainty and impacting investor confidence. Such volatility can be disruptive, especially for retail investors with limited risk appetite. Another challenge is the potential for overdependence on foreign capital. If FIIs pull back sharply due to global factors, it can create a funding gap and impact India's economic stability. This highlights the need to diversify sources of capital and reduce reliance on any single group of investors. Excessive FII influence can also make the Indian market vulnerable to external shocks and policy changes in developed economies. This underscores the need for robust domestic policies and a resilient financial system that can withstand external pressures.